Let's talk about the most polite potential economic catastrophe in modern history. Because if Japan decides to do the thing that Japan might be forced to do, the thing that its own domestic economic situation is increasingly pushing it toward, the consequences for the American economy would be severe, immediate, and felt by every person in the United States who has a mortgage, a car loan, a credit card, a retirement account, or a general preference for the economy not collapsing. And the delightful part, if you can call it that, is that Japan wouldn't even be doing it maliciously. There would be no dramatic press conference, no declaration of economic warfare, no villain twirling a mustache in front of a map of the United States, just a nation of extraordinarily polite people making rational financial decisions in response to their own domestic economic pressures, and those rational decisions happening to be the financial equivalent of pulling the load-bearing wall out of the American economy. Here's the setup. Japan currently holds approximately $1.1 trillion in United States Treasury bonds, United States government debt. This makes Japan the single largest foreign holder of American debt on the planet, a position it has held for much of the past 3 decades through the specific combination of Japan's enormous domestic savings pool, its export-driven economic model, and a particular monetary policy experiment, one of the most audacious in modern central banking history, that has been running for decades and is now showing signs of ending. When Japan bought all that American debt, it was a mutually convenient arrangement. Japan needed somewhere to park its vast savings at decent returns. The United States needed someone to buy the enormous quantities of debt it was issuing to fund its government spending. Everyone was happy. The relationship was so stable, so reliable, so utterly boring in its dependability that most Americans have never heard of it, let alone thought about what happens when it changes. It is changing. The Bank of Japan, Japan's central bank, has spent decades suppressing Japanese interest rates at near zero or literally below zero levels through a policy called yield curve control. That policy is unwinding. Japanese interest rates are rising, and as Japanese interest rates rise, the specific financial logic that made U.S. Treasury bonds attractive to Japanese investors weakens. At some point, perhaps gradually, perhaps rapidly, depending on how Japanese domestic conditions evolve, Japanese investors and the Japanese government may find that selling U.S. Treasury bonds and investing those proceeds in Japanese assets makes more financial sense than continuing to hold American debt at rates that Japanese alternatives now approach or exceed. The scenario where that happens in a large, rapid, disorderly way is the scenario this video is about. It is not a certain scenario. It is not an imminent scenario in the sense of next Tuesday, but it is a specific, mechanistically grounded, increasingly discussed scenario that is more probable today than it was 5 years ago, and whose consequences are severe enough that understanding it is among the most important pieces of economic literacy available in the current environment. So let's understand it completely from the beginning. Starting with why Japan has over $1 trillion of American debt in the first place, and how an island nation of 125 million people became the financial codependent of the world's largest economy in a relationship that neither side fully acknowledges and both sides desperately need to continue. Chapter 1. How Japan became America's biggest creditor, the story nobody told you. Here's the origin story of the most consequential financial relationship between two countries in the modern era, the specific historical sequence that produced Japan's extraordinary position as the largest foreign holder of U.S. Treasury bonds, a position that was not planned, not inevitable, and not fully understood even by many of the economists and policymakers who were present for its development. To understand how Japan ended up holding more than $1 trillion of American debt, you need to understand 3 specific developments that happened in sequence over approximately 4 decades, each one building on the previous, each one seeming reasonable at the time, and all of them together producing a financial interdependency that is now so deep that unwinding it creates the specific risks this video describes. Development 1. The export machine and the savings accumulation. Here's the first piece of the puzzle, the specific economic model that Japan built in the post-war decades that produced the enormous savings pool that eventually needed somewhere to go. Japan's post-war economic development, the economic miracle of the 1950s through the 1980s, was built on a specific industrial model, high-quality manufactured goods produced for export to foreign markets, particularly the United States. Toyota, Honda, Sony, Panasonic, Toshiba, Canon, the names that became synonymous with reliable, affordable quality in the American consumer market were the specific products of a deliberate industrial strategy that prioritized export earnings over domestic consumption. This model generated enormous trade surpluses. Japan sold far more to the United States than it bought from the United States. Those trade surpluses generated dollar earnings. The American consumers who bought Japanese cars and electronics paid in dollars. Japan accumulated those dollars. A lot of dollars. Year after year, decade after decade, the trade surplus generated a growing pool of dollar-denominated assets that needed to be invested somewhere. The specific numbers illustrate the scale. Japan ran trade surpluses with the United States every year from the early 1970s through the present, with the exception of a few years following the 2011 earthquake and tsunami. The cumulative trade surplus over this period is measured in the trillions of dollars. This is not a small imbalance. It is the specific financial product of a multi-decade economic relationship in which Japan provided goods and the United States provided dollars. The dollars that Japan accumulated needed to earn a return. They could not sit in cash indefinitely. They needed to be invested in assets denominated in dollars, because converting them entirely to yen would have required selling dollars and buying yen, which would have strengthened the yen, made Japanese exports more expensive, reduced competitiveness, and undermined the export model that generated the dollars in the first place. Japan was, in the specific financial sense, trapped by its own success. It had to recycle its dollar earnings back into dollar assets to avoid destroying the mechanism that generated those dollar earnings. The most attractive dollar asset available in the volume that Japan needed, U.S. Treasury bonds. Development 2, the Plaza Accord and the yen shock. Here's the second development that deepened Japan's Treasury bond holdings, the specific geopolitical event that forced Japan to recalibrate its economic model, and in doing so amplified the flow of Japanese savings into American debt. By the mid-1980s, the United States had grown frustrated with its trade deficit with Japan. The Reagan administration, working with other G7 nations, engineered the Plaza Accord of 1985, an agreement under which major currencies would be managed to depreciate the dollar and appreciate the yen, specifically to reduce the U.S. trade deficit with Japan and Germany. The Plaza Accord worked in the specific sense of appreciating the yen, which rose approximately 50% against the dollar over the 2 years following the agreement. This made Japanese exports significantly more expensive in dollar terms, which was exactly what the accord intended, but it also had specific consequences for the Japanese economy that its architects did not fully anticipate. The yen appreciation squeezed Japanese exporters' margins and threatened the export-led growth model. The Bank of Japan responded by cutting interest rates aggressively to stimulate the domestic economy, and this produced the specific financial bubble of the late 1980s, where cheap money flowed into Japanese real estate and equity markets, producing the extraordinary asset price inflation that saw Tokyo real estate valued at levels that implied the Imperial Palace grounds were worth more than the entire state of California. When that bubble collapsed in the early 1990s, one of the most dramatic asset price collapses in modern financial history, it left the Japanese banking system loaded with bad loans against collateral whose value had evaporated. The Japanese economy entered a prolonged period of stagnation, the lost decade that became 2 lost decades and arguably 3, characterized by weak growth, deflation risk, and the specific economic malaise that produced the extraordinary monetary policy response that is now unwinding. During this entire extended period of domestic economic stagnation, Japanese investors, confronted with low returns on Japanese assets and a domestic banking system under stress, sought the relative safety and higher yields of U.S. Treasury bonds. The Treasury bond purchases that had begun as the recycling of trade surplus earnings continued and deepened as a flight from Japanese domestic asset risk. Development 3. Yield curve control and the widening differential. Here's the third and most recent development, the specific monetary policy that produced the largest acceleration of Japanese Treasury bond accumulation, and that is now in the process of ending, with the specific consequences for the Treasury market that this video is about. In 2016, the Bank of Japan launched one of the most extraordinary monetary policy experiments in modern central banking history: yield curve control, or YCC. The policy committed the Bank of Japan to purchasing whatever quantity of Japanese government bonds was necessary to keep the yield on 10-year Japanese government bonds near 0%. Not approximately zero, not a target range. A specific ceiling enforced by the central bank's willingness to buy unlimited quantities of bonds to defend it. The specific logic of yield curve control was the stimulation of the Japanese economy through the maintenance of ultra-low borrowing costs. The same logic that drives all quantitative easing programs, but executed with a more explicit and more aggressive commitment than most central banks have been willing to make. The Bank of Japan would do whatever it took to keep Japanese rates near zero. The consequence for U.S. Treasury bonds: while the Bank of Japan was suppressing Japanese interest rates near zero, U.S. Treasury bonds were offering positive yields, initially modest, then increasingly attractive as the Federal Reserve raised rates aggressively in 2022 and 2023 to combat inflation. The differential between Japanese yields near zero, enforced by the Bank of Japan, and U.S. Treasury yields, rising to 4% and then 5%, created a powerful incentive for Japanese investors to hold U.S. Treasury bonds rather than Japanese bonds. The specific financial mechanism: Japanese insurance companies, pension funds, and other institutional investors manage enormous pools of capital. The savings of Japanese households accumulated over decades. Those institutions need to earn returns on their assets to meet their obligations. With Japanese bond yields near zero, the only way to earn meaningful returns was to invest in foreign bonds with higher yields, primarily U.S. Treasury bonds. The yield differential between Japanese and American government bonds was, for much of the 2022 to 2024 period, 4 to 5 percentage points, an extraordinary gap that made U.S. Treasury bonds extremely attractive to yield-hungry Japanese institutional investors. This is how Japan came to hold more than $1.1 trillion in U.S. Treasury bonds, not through a single decision, not through malicious intent, through the specific accumulation of a trade surplus that had to be recycled into dollar assets, the flight from Japanese domestic asset risk during the lost decades, and the explicit yield differential that yield curve control created by suppressing Japanese rates while U.S. rates rose. And now the yield curve control is ending. Japanese rates are rising, and the specific financial logic that produced the $1.1 trillion accumulation is reversing. Chapter 2: The Yield Curve Control Unwind, the Monetary Policy Experiment That's Ending. Here's the chapter that explains the specific policy development that makes the Japan-U.S. Treasury relationship suddenly relevant to anyone who has a financial stake in the American economy: the unwinding of yield curve control that is gradually and then potentially rapidly reversing the financial incentives that produce Japan's extraordinary Treasury bond holdings. To understand why the yield curve control unwind matters, you need to understand what yield curve control was actually doing to the financial system, both inside Japan and globally, and why the Bank of Japan has been forced to begin abandoning it despite the specific discomforts that the abandonment is producing. What yield curve control was actually doing. Here's the specific mechanism of yield curve control, described plainly enough that you don't need a PhD in monetary economics to understand why it was extraordinary and why its unwinding is significant. The Bank of Japan committed to buying whatever quantity of Japanese government bonds was necessary to prevent the yield on 10-year Japanese government bonds from rising above a specified ceiling, initially 0%, then adjusted to 0.25%, then 0.5%, and now effectively higher as the policy has been progressively relaxed. The mechanics: when market interest rates would otherwise have risen above the ceiling, because investors demanded higher yields as compensation for inflation expectations, credit risk, or simply because other markets offered better returns, the Bank of Japan would buy bonds in the open market, creating artificial demand that pushed bond prices up and yields down. If necessary, the Bank of Japan would buy every bond offered at the ceiling yield, an unlimited commitment that made the ceiling credible precisely because no rational investor would bet against a central bank with the ability to create unlimited domestic currency. the consequence of this unlimited buying. The Bank of Japan now owns approximately 50% of all outstanding Japanese government bonds, an extraordinary concentration of ownership that reflects the years of unlimited purchasing required to maintain the yield ceiling. This is not a typo. The Central Bank of Japan owns approximately half of its country's government debt. This is the specific quantitative expression of what yield curve control does when it runs for years. The global consequence, by keeping Japanese interest rates near zero while other major central banks, particularly the Federal Reserve, raised rates to combat inflation, the Bank of Japan created the specific yield differential that made Japanese money flow into overseas assets. Japanese institutional investors borrowed in yen at near zero rates and invested in U.S. Treasury bonds at 4% to 5% yields, a carry trade that was essentially free money as long as the exchange rate remained stable. This yen carry trade amplified the flow of Japanese capital into U.S. Treasuries, beyond what the trade surplus recycling alone would have produced. Why yield curve control is ending. The domestic pressure that forced the change. Here's the specific set of domestic economic pressures that have forced the Bank of Japan to begin abandoning yield curve control, the pressures that have made the policy increasingly costly to maintain and increasingly misaligned with Japan's actual economic needs. The first pressure, inflation, arrived in Japan. After 30 years of deflation or near deflation, the specific economic condition that yield curve control was designed to combat, Japan began experiencing meaningful inflation in 2022 and 2023, driven by the global commodity price increases of the post-COVID era and the specific weakness of the yen that yield curve control produced. Japan imports the vast majority of its energy and a significant fraction of its food. When commodity prices rose globally, Japan's import costs rose dramatically, and the weak yen made those imports even more expensive in yen terms. Japanese consumer price inflation reached approximately 4% in 2023, modest by the standards of the US or European inflation episodes, but the highest inflation Japan had experienced in 4 decades, and an extraordinary development for an economy that had spent 30 years trying to prevent prices from falling. The Bank of Japan's mandate includes price stability, and maintaining near zero interest rates in the face of 4% inflation was increasingly difficult to defend as consistent with that mandate. The second pressure, the yen's weakness. Yield curve control kept Japanese interest rates near zero, while US rates rose to 5%. The interest rate differential, the most important determinant of exchange rate movements in the short to medium term, produced a dramatic depreciation of the yen against the dollar. From approximately 115 yen per dollar in early 2022 to approximately 155 yen per dollar in 2024, a depreciation of more than 30% in 2 years. Yen weakness has mixed consequences for Japan. It benefits exporters. A weaker yen makes Japanese goods cheaper in dollar terms, improving export competitiveness, but it is deeply damaging for Japanese consumers, who face higher prices for everything Japan imports, particularly food and energy, and for Japanese institutional investors who hold the yen-denominated obligations of their domestic liabilities while their yen's international purchasing power deteriorates. The political pressure from yen weakness became increasingly intense in 2023 and 2024, Japanese households experiencing the cost of living squeeze from import price inflation and currency depreciation generated the specific political demand for policy change that central banks, whatever their formal independence, cannot entirely ignore. The third pressure, the demographic and fiscal reality. Japan has one of the oldest populations in the developed world. Approximately 30% of its population is over 65, and a fiscal situation that reflects decades of deficit spending to address the economic stagnation of the lost decades. Japanese government debt as a percentage of GDP exceeds 260%, the highest of any developed economy by a significant margin. The zero interest rate policy was specifically valuable to the Japanese government because it meant that servicing this extraordinary debt load cost almost nothing. As interest rates rise, even modestly, the fiscal cost of servicing 260% of GDP in debt becomes significant very quickly. The policy normalization path: how fast and how far? Here's the specific trajectory of Bank of Japan policy normalization that is currently underway. the path from yield curve control to a more conventional monetary policy framework, and the specific waypoints that have already been passed and those that lie ahead. The Bank of Japan began raising its policy rate in March 2024 for the first time since 2007, ending the era of negative interest rates that had persisted since 2016. The initial rate increase was modest, from minus 0.1% to approximately 0 to 0.1%, but it was the specific signal that the policy direction had definitively changed. Subsequent increases have been gradual but consistent. The yield curve control policy itself was formally abandoned in its strictest interpretation. The Bank of Japan removed the hard cap on 10-year Japanese government bond yields, replacing it with a more flexible framework that allows yields to rise more freely in response to market conditions. 10-year Japanese government bond yields, which were pinned near zero by the cap, have risen to approximately 1% to 1.5% and are expected to continue rising as the policy normalization proceeds. The critical question for the U.S. Treasury market: how high will Japanese interest rates ultimately go? The Bank of Japan's policy normalization is expected to be gradual. The domestic debt burden and the fragility of Japan's economic recovery make aggressive rate increases risky. But even a gradual normalization to a Japanese policy rate of 1% to 2% would dramatically change the financial calculus for Japanese investors holding U.S. Treasury bonds. At a 5% U.S. Treasury yield and a 0% Japanese rate, the yield differential is 5 percentage points, a powerful incentive to hold U.S. Treasuries. At a 4% U.S. Treasury yield and a 2% Japanese rate, the yield differential is 2 percentage points, a much weaker incentive, particularly once the currency hedging costs are factored in. At a 3% U.S. Treasury yield and a 2% Japanese rate hedged of currency risk, the differential essentially disappears, removing the specific financial reason for Japanese investors to hold U.S. Treasury bonds rather than Japanese alternatives. Chapter 3: The Yen Carry Trade, the most dangerous trade in global finance. Here's the chapter that explains the specific financial mechanism that makes the Japan-U.S. Treasury relationship more systemically dangerous than the simple Japan holds a lot of U.S. bonds framing suggests. The yen carry trade, which is both the amplifier of Japanese Treasury holdings and a specific source of global financial instability that goes far beyond the bilateral Japan-U.S. relationship. The yen carry trade is not a complex concept, but its implications are profound enough that understanding it is essential to understanding why the yield curve control unwind is a global financial event rather than merely a Japan-U.S. bilateral development. The carry trade mechanics: borrowing cheap to invest expensively. Here's the specific mechanism of the yen carry trade, described in terms concrete enough to understand without a finance background. A carry trade is any financial transaction where an investor borrows in a low interest rate currency and invests in a high interest rate currency or asset. The investor profits from the interest rate differential, paying a low borrowing cost in one currency and earning a higher return in another. The yen carry trade: a Japanese investor, or a global investor with access to yen borrowing, borrows yen at the near zero interest rates that yield curve control maintained. They convert those yen to dollars at the prevailing exchange rate. They invest the dollars in U.S. Treasury bonds, earning 4% to 5%. They earn the interest rate differential, approximately 4% to 5% per year, essentially for free, as long as the exchange rate between yen and dollars remains stable. The specific scale of this trade: it is not a marginal niche financial strategy. It is one of the most widely deployed trades in global finance, executed by Japanese institutional investors, by global hedge funds, by investment banks, and by a range of financial actors for whom the yen's specific low-rate status made it the preferred funding currency for leveraged investment strategies globally. The specific estimate of the total outstanding yen carry trade position is inherently uncertain because much of it exists in the off-balance sheet structures of hedge funds and the derivatives books of investment banks that are not publicly disclosed. Estimates of the total outstanding yen carry trade range from $4 trillion to $20 trillion, a range wide enough to indicate how genuinely uncertain the measurement is, and a lower bound large enough to indicate how systemically significant its unwinding would be. The carry trade unwind: when cheap funding becomes expensive. Here's the specific mechanism through which the yen carry trade unwinds, and why the unwinding produces the global financial volatility that makes the carry trade one of the most systematically dangerous trades in global finance. The carry trade is profitable as long as two conditions are maintained: the interest rate differential remains positive, yen borrowing remains cheaper than the return on the invested asset, and the exchange rate moves favorably or at least neutrally. If either condition fails, the carry trade becomes unprofitable and potentially produces losses. The yen carry trade has a specific vulnerability to yen appreciation. When the yen strengthens against the dollar, which tends to happen during periods of global financial stress, when investors exit risky positions and Japanese institutional investors repatriate foreign investments, the carry trade investor who borrowed in yen and invested in dollar assets faces a specific double loss. The dollar assets decline in value relative to the yen liabilities. The more the yen appreciates, the more the carry trade investor loses, and the greater the urgency to close the position, which means selling the dollar assets and buying yen to repay the yen loan. The self-reinforcing dynamic, carry trade unwinding, produces yen buying, which strengthens the yen, which triggers more carry trade unwinding, which produces more yen buying, which strengthens the yen further. This feedback loop is the specific mechanism that produces the rapid, large-scale yen appreciation events that global financial markets have experienced multiple times, most dramatically in August 2024, when a combination of Bank of Japan rate hikes and global risk-off sentiment produced a yen appreciation that triggered carry trade unwinding of sufficient scale to produce significant global equity market declines. The August 2024 event was a preview, a specific demonstration of what yen carry trade unwinding looks like when it begins to occur at scale. The yen appreciated approximately 10% in a matter of weeks. Global equity markets declined sharply, not because global corporate earnings had deteriorated, but because the yen carry trade unwinding forced the selling of risk assets globally to fund yen purchases. The Nikkei, the Japanese equity index, declined approximately 12% in a single session at the worst point of the episode. The episode resolved relatively quickly as the Bank of Japan communicated its intention to proceed cautiously with rate increases, which reduced the urgency of carry trade unwinding and allowed financial markets to stabilize. But the episode was a specific demonstration of the mechanism, and it occurred with the yen carry trade still mostly intact. The scenario where the carry trade unwinds more completely because Japanese rates rise further than the Bank of Japan currently intends, because global financial stress triggers a simultaneous rush to safety, or because the differential narrows to the point where holding the trade no longer makes financial sense, would produce a significantly larger version of the same dynamic. The Treasury bond selling component, the most direct channel. Here's the specific component of the yen carry trade unwind that most directly threatens the U.S. Treasury market, the forced selling of U.S. Treasury bonds that yen carry trade unwinding produces. When yen carry trade investors unwind their positions, the specific sequence is: sell the dollar-denominated asset that was funded by the yen borrowing, convert the dollar proceeds back to yen, repay the yen borrowing. The dollar-denominated asset that was funded by the yen borrowing is, for a significant fraction of yen carry trade positions, U.S. Treasury bonds. The scale of potential Treasury selling from carry trade unwinding depends on the fraction of the outstanding carry trade that is invested in U.S. Treasury bonds rather than other dollar assets, a fraction that is genuinely uncertain, but that is likely in the hundreds of billions of dollars given the scale of Japanese institutional Treasury holdings and the specific attractiveness of Treasuries as the largest, most liquid, most standardized dollar asset available. The combination of carry trade unwinding and Japanese institutional repatriation, the separate but related decision by Japanese pension funds and insurance companies to sell U.S. Treasuries and buy Japanese bonds as Japanese yields rise, is the specific dual mechanism that produces the scenario this video is ultimately about: a large, potentially rapid increase in the supply of U.S. Treasury bonds in the market at the same moment that the underlying demand for those bonds is weakening. The currency hedge cost, the hidden killer of Treasury attractiveness. Here's the specific technical dimension of the Japanese Treasury holding situation that most people outside the fixed income market are not aware of: the currency hedging cost that, for many Japanese institutional investors, makes the net yield on hedged U.S. Treasury holdings significantly less attractive than the headline Treasury yield suggests. Japanese institutional investors, particularly life insurance companies and pension funds, are not permitted to take unlimited, unhedged currency risk. Their liability structures are in yen. They owe yen-denominated benefits to their Japanese policyholders and beneficiaries, and regulations and risk management frameworks require them to hedge the currency exposure of foreign currency-denominated assets. When they buy U.S. Treasury bonds, they purchase currency hedges, instruments that lock in a specific exchange rate for the future conversion of dollar proceeds back to yen. The cost of this currency hedge is approximately equal to the interest rate differential between the U.S. and Japan, which is precisely the yield differential that makes U.S. Treasuries attractive in the first place. The currency hedge that converts dollar returns to yen essentially eliminates the advantage of the higher U.S. yield. In the specific period of the largest yield differential, when U.S. rates were at 5% and Japanese rates were near zero, the 5% hedging cost consumed the entire yield differential, leaving Japanese hedged investors with a net yield on U.S. Treasuries approximately equal to Japanese bond yields. The Treasuries weren't actually more attractive than Japanese bonds on a currency hedged basis. They were equivalent at best. This means that a significant fraction of Japanese Treasury holdings are held on an unhedged basis, accepting the currency risk of dollar appreciation or depreciation in exchange for the higher nominal yield. These unhedged positions are specifically vulnerable to yen appreciation, and they are the positions most likely to be sold when Japanese domestic alternatives improve. Chapter 4. What happens when Japan sells? The Treasury Market Mechanics. Here's the chapter that gets to the specific financial mechanics of what actually happens in the U.S. Treasury market when Japan begins selling its holdings at scale, the specific transmission mechanism from Japanese selling decisions to American borrowing costs, mortgage rates, and the broader U.S. economy. To understand why Japanese Treasury selling is potentially catastrophic rather than merely inconvenient, you need to understand how the Treasury market actually works, how it clears, what determines yields, and why a specific category of selling at a specific scale produces the kind of dislocation that the financial system is not designed to absorb without significant stress. The Treasury market, the most important financial market in the world. Here's the specific context for why the U.S. Treasury market is the foundation on which the entire global financial system rests, and why disruption to its functioning is qualitatively different from disruption in any other asset market. U.S. Treasury bonds are the global financial system's risk-free asset. They are the benchmark against which every other fixed income investment is priced. The yield on the 10-year U.S. Treasury bond is the specific number from which virtually every interest rate in the American economy is derived. Mortgage rates, corporate bond rates, auto loan rates, the discount rates used to value every equity investment, the cost of capital for every business in America. When the 10-year Treasury yield rises by 1 percentage point, mortgage rates typically rise by a comparable amount, adding approximately $200 per month to the payment on a $400,000 mortgage. When Treasury yields rise by 2 percentage points, the effect on mortgage payments, corporate borrowing costs, and the valuation of every financial asset in the economy is correspondingly larger. The Treasury yield is not just a number on a Bloomberg terminal, it is the specific mechanism through which the financial cost of everything in the American economy is set. The Treasury market is also the largest and most liquid financial market in the world. Daily trading volumes typically exceed $700 billion. This enormous liquidity is part of what makes Treasuries the world's risk-free asset. The ability to buy or sell large quantities quickly at prices close to the last trade without moving the market significantly. But this liquidity is not infinite, and the specific events that stress Treasury market liquidity, the March 2020 COVID panic, the September 2022 UK gilt crisis, have demonstrated that even the world's most liquid market can experience severe functioning problems when large-scale selling overwhelms the available buyer base. The mechanics of large-scale selling, how $1.1 trillion changes the market. Here's the specific market mechanics of what happens when a holder of $1.1 trillion in Treasury bonds begins selling, the auction dynamics, the yield impact, and the specific feedback loops that make large-scale selling self-reinforcing. The Treasury market absorbs normal daily buying and selling, the routine portfolio management of the thousands of institutional investors who hold Treasury bonds, without significant price impact because the scale of normal trading is small. relative to the total outstanding stock of treasury bonds. When a seller comes to the market with an unusually large position, the market's ability to absorb the selling without significant price impact depends on the availability of buyers willing to purchase at or near the current market price. The available buyer base for U.S. Treasury bonds is specific and not unlimited. The Federal Reserve, which was a major buyer through its quantitative easing programs, is currently reducing its Treasury holdings through quantitative tightening, making it a net seller rather than a buyer. Foreign central banks outside Japan are also in various stages of reserve management that are not providing the consistent buying support they provided in previous decades. The domestic institutional investor base, pension funds, insurance companies, mutual funds, provide significant demand but at price points that reflect their specific return requirements rather than unlimited absorption capacity. When selling pressure from a large holder, Japan, exceeds the current buyer base's capacity to absorb it at prevailing prices, the market adjusts by moving prices lower, which means yields higher. Higher yields attract additional buyers. Investors who were not interested at lower yields become interested at higher yields. The market eventually clears, but at a higher yield level than existed before the selling began. The specific concern about Japanese selling is not that it would produce permanent unlimited yield increases. The Treasury market would eventually find a clearing level. The concern is the specific scale and potential speed of the adjustment. $1.1 trillion in Treasury bonds represents approximately 4% of the total outstanding stock of approximately $27 trillion in U.S. government debt. A forced sale of 4% of the total outstanding stock, particularly if it occurred over months rather than years, would produce a yield adjustment whose magnitude would depend critically on the pace of selling and the availability of alternative buyers. The term premium, the hidden cost that amplifies everything. Here's the specific financial concept that makes the Treasury yield impact of large-scale Japanese selling larger than the simple supply-demand arithmetic would suggest. The term premium, which is the additional yield that investors require as compensation for the specific risks of holding long-duration bonds rather than rolling over short-term bills. The term premium is the component of the long-term Treasury yield that compensates investors for duration risk. The risk that interest rates change over the holding period, producing capital gains or losses on the bond. When the term premium is low, as it has been for much of the past 2 decades, long-term Treasury yields are close to the market's expectation of future short-term rates, and there is minimal additional compensation for holding duration. When large-scale selling pressure from Japan or other major holders increases the supply of Treasury bonds in the market, the term premium tends to rise. Investors demand more compensation for the increased supply risk. A rise in the term premium produces a rise in long-term Treasury yields that is independent of any change in the Federal Reserve's policy rate. It is a market-determined adjustment to the risk of holding long-duration assets in an environment of elevated supply. The specific amplification mechanism. If Japanese selling causes the term premium to rise by 0.5 percentage points, a historically plausible adjustment given the scale of the potential selling, and that term premium increase adds 0.5 percentage points to the 10-year Treasury yield, the effect on mortgage rates and other long-term borrowing costs is the same as if the Federal Reserve had raised its policy rate by 0.5 percentage points. The tightening of financial conditions occurs without any action by the Federal Reserve, driven entirely by the supply-demand dynamics of the Treasury market. The Federal Reserve's limited ability to offset this dynamic. The Fed controls the short-term policy rate, the federal funds rate, directly. It influences long-term Treasury yields indirectly, through the communication of future policy intentions and through asset purchase programs. If Japanese selling drives long-term Treasury yields higher through term premium increases, the Fed's ability to prevent the tightening of long-term financial conditions without restarting large-scale asset purchases, quantitative easing, is limited. And restarting quantitative easing in an environment of elevated inflation would be the specific policy contradiction that would most severely damage the Fed's credibility and the dollar's reserve currency status. The auction dynamics. When the Treasury Department's biggest customer leaves. Here's the specific mechanism through which Japanese selling most directly affects the U.S. Treasury's ability to fund the U.S. government. the weekly and monthly treasury auction process through which new government debt is sold to the market. The U.S. Treasury issues new bonds continuously through a regular auction schedule, weekly bills, monthly notes, and bonds across multiple maturities. These auctions are the specific mechanism through which the federal government's ongoing deficit spending is financed. The auctions must succeed. The Treasury must find buyers for the bonds it issues at yields the government can service, or the government faces the specific funding crisis that every financially stressed government in history has eventually confronted. Japanese institutional investors have historically been among the most reliable participants in Treasury auctions, the indirect bidder category that captures foreign central bank and institutional buying. Their consistent demand has helped keep Treasury auction yields below what domestic demand alone would have required. When Japanese buying at auctions declines, as it would if Japanese investors are simultaneously selling existing holdings and reducing new purchases, the auction clearing yields rise to attract sufficient domestic and other foreign demand. The specific failed auction scenario, where a Treasury auction receives insufficient bids at yields close to prevailing market rates and the government is forced to pay dramatically higher rates to clear the auction, is the extreme version of this dynamic. The U.S. Treasury has not experienced a genuinely failed auction in modern history. The possibility of one, driven by the simultaneous reduction of Japanese buying and the absence of an adequate alternative buyer base, is the specific tail risk that makes the Japanese Treasury situation more concerning to the professional fixed income community than to most public commentators. The feedback loop to the real economy, from Treasury yields to your mortgage. Here's the specific transmission from Treasury market mechanics to the daily financial reality of American households and businesses, the specific channels through which rising Treasury yields from Japanese selling pressure would affect the economy you live in. Mortgage rates. The 30-year fixed mortgage rate is priced at a spread above the 10-year Treasury yield. If Japanese selling raises the 10-year Treasury yield by 1 percentage point, from, say, 4.5% to 5.5%, mortgage rates rise by approximately the same amount, from approximately 7% to approximately 8%. The monthly payment on a $400,000 mortgage at 7% is approximately $2,661. At 8%, it is approximately $2,935. The $274 monthly increase in mortgage payments reduces housing affordability further, suppresses home purchases further, and deepens the housing affordability crisis described in the previous video. Corporate borrowing costs. U.S. corporations issue bonds at yields that reflect a credit spread above comparable Treasury yields. Rising Treasury yields raise the baseline from which corporate bond yields are priced, increasing the cost of corporate borrowing across all credit quality levels. Higher corporate borrowing costs reduce business investment, the capital expenditure that drives economic growth and employment. The U.S. government's own debt service costs. The most directly affected borrower when Treasury yields rise is the U.S. government itself. As described in Chapter 2 of the previous video, the U.S. government is already spending over $1 trillion per year in interest on its existing debt. Each 1 percentage point increase in the average interest rate on the outstanding stock of federal debt adds approximately $270 billion to annual interest expense, a number that approaches the entire annual defense budget in its magnitude. Japanese selling-driven yield increases would therefore directly and immediately worsen the U.S. fiscal situation that is already under significant stress. The equity market valuation effect. Equities are valued as the present value of future earnings, discounted, at a rate that includes the risk-free Treasury yield. When the risk-free rate rises, driven by Japanese selling or any other factor, the discount rate applied to future earnings increases, reducing the present value of those earnings and therefore reducing appropriate equity valuations. The specific quantitative relationship, a 1 percentage point rise in the 10-year Treasury yield, all else equal, reduces the theoretically appropriate price-to-earnings ratio for equities by approximately 10% to 15%, a significant valuation headwind that would translate into lower equity prices if the earnings outlook remained constant. Chapter 5. The historical precedents. When creditors sell, what actually happens? Here's the chapter that grounds the theoretical analysis of the previous chapters in the specific historical evidence of what actually happens when major foreign holders of government debt begin selling, the documented cases from which we can extract the most reliable Lessons about the likely consequences of large-scale Japanese treasury liquidation. The United States has not previously faced the scenario of its largest foreign creditor liquidating its holdings at scale, but there are specific historical analogs, cases where large-scale selling of government bonds by significant holders produced the specific market and economic consequences that the theoretical framework predicts, and studying those cases carefully provides the most credible basis for assessing what the Japanese scenario would actually look like in practice. The UK gilt crisis of September 2022. The closest modern analog. Here's the historical precedent that most closely approximates the mechanics of the Japanese treasury scenario. The UK gilt market crisis of September 2022 that produced one of the most dramatic illustrations of bond market dynamics in modern financial history. The UK gilt crisis was triggered by a specific policy announcement, the Truss government's mini-budget of September 23, 2022, which proposed unfunded tax cuts of approximately £45 billion. The announcement was immediate in its market impact. Gilt investors, concerned about the fiscal implications of the policy, began selling UK government bonds. Yields rose sharply. The selling triggered a specific cascade in the UK pension fund sector. The pension funds that had used leverage strategies tied to gilt prices faced margin calls as gilt prices fell, forcing them to sell gilts to meet those margin calls, which drove gilt prices down further, triggering more margin calls, producing more selling. The 10-year UK gilt yield rose from approximately 3.5% before the mini-budget to approximately 4.5% within days, a 1 percentage point increase in less than a week. The Bank of England was forced to intervene with emergency bond purchases, the specific reversal of its quantitative tightening policy, to prevent a disorderly market collapse. The intervention worked, but only after the Bank of England committed to buying £65 billion of long-term gilts. The lessons from the UK gilt crisis that apply directly to the Japanese treasury scenario? First, bond markets can move very quickly when a large seller meets an inadequate buyer base. The UK gilt market, the fourth largest government bond market in the world, experienced a 1 percentage point yield spike in days, not months. The US Treasury market is much larger and more liquid than the UK gilt market, which provides more cushion against rapid movements, but the principle that large-scale selling produces rapid yield increases when buyers are insufficient is clearly established. Second, the feedback loops from rising yields to forced selling are specific and documented. The UK pension fund margin calls that amplified the gilt selling are the direct analog of the carry trade unwinding described in Chapter 3, a different mechanism, but the same dynamic of forced selling, amplifying the initial market move. Third, central bank intervention can stabilize the market, but at the cost of policy credibility and the specific contradiction of buying bonds while trying to reduce inflation. The Bank of England's emergency intervention was effective in the short term but complicated by the inflation environment. The bank was trying to tighten financial conditions to combat inflation while simultaneously loosening them through emergency bond purchases. The Fed would face the same contradiction in a U.S. Treasury stress event, the taper tantrum of 2013, the preview of yield sensitivity. Here's the second historical precedent. The taper tantrum of 2013 that occurred when Federal Reserve Chairman Ben Bernanke suggested, in congressional testimony, that the Fed might begin tapering its Treasury bond purchases. The market reaction to this suggestion, not even an announcement, just a suggestion, was immediate and significant. 10-year Treasury. Yields rose from approximately 1.6% to approximately 3% in the space of a few months, a 1.4 percentage point increase in response to the suggestion of reduced Fed buying. Emerging market economies that had borrowed in dollars experienced capital outflows and currency crises as the prospect of higher U.S. rates made dollar assets more attractive relative to their domestic assets. The taper tantrum demonstrates two specific lessons relevant to the Japanese scenario. First, the Treasury market is highly sensitive to changes in the expected behavior of major buyers. The suggestion that one large buyer might reduce purchases produced a dramatic yield increase, establishing the principle that Japanese selling would produce qualitatively similar reactions. Second, the global spillover effects of Treasury yield movements are rapid and severe. The emerging market disruptions of 2013 showed that rising U.S. Treasury yields don't stay in the Treasury market, they propagate through the global financial system with speed and breadth that the initial yield increase doesn't fully convey. The Japan government bond market itself, the domestic preview. Here's the third historical precedent: the specific episodes in the Japanese government bond market itself where the Bank of Japan's yield curve control was tested, and where the market dynamics of defending an artificial yield ceiling were most visible. In late 2022 and early 2023, the Bank of Japan was forced to buy extraordinary quantities of Japanese government bonds to defend its yield curve control ceiling as global rate increases put upward pressure on Japanese yields. At the peak of the YCC defense, the Bank of Japan was purchasing Japanese government bonds at an annualized rate of approximately $1 trillion, buying approximately half of all new issuance plus additional quantities of existing bonds to prevent yields from breaking above the ceiling. This extraordinary buying pace demonstrated that the yield curve control policy was under severe stress, that the artificial suppression of Japanese yields required ever larger quantities of central bank bond purchases as the market pressure to allow yields to rise increased. The eventual abandonment of the strict YCC ceiling was the specific recognition that the policy had become unsustainable, that the costs of maintaining it exceeded the benefits. The lesson for the U.S. Treasury scenario, the market forces that ultimately overwhelmed the Bank of Japan's ability to suppress Japanese yields are the same forces, the fundamental relationship between interest rates, inflation, and capital flows that would make any artificial suppression of U.S. Treasury yields through emergency Federal Reserve buying ultimately unsustainable in an inflationary environment. The specific policy tool that the Fed would use to respond to Japanese selling pressure, large-scale bond purchases, is the same tool that the Bank of Japan used to defend YCC, and that tool has demonstrated both its short-term effectiveness and its long-term unsustainability. The China precedent, the non-event that provides context. Here's the fourth historical case. The specific episode where China, the second largest foreign holder of U.S. Treasuries, reduced its holdings significantly without producing the catastrophic market disruption that the theoretical analysis might predict. China's U.S. Treasury holdings peaked at approximately $1.3 trillion in 2013 and have declined to approximately $780 billion as of recent data, a reduction of approximately $520 billion over approximately a decade. This reduction has not produced the dramatic Treasury yield spike or financial crisis that the naive analysis would predict from such large-scale selling. The reasons why China's gradual selling has not produced catastrophic market disruption are specific and instructive for the Japanese scenario. First, the selling was gradual, spread over a decade rather than concentrated in a short period, allowing the market to adjust incrementally rather than experiencing a shock. Second, the domestic and foreign buyer base for U.S. Treasuries expanded during the period of Chinese selling. Other foreign central banks increased holdings. U.S. domestic institutional demand remained strong, and Fed quantitative easing provided direct backstop buying during specific periods of market stress. The lesson from the China precedent is not reassuring in the most optimistic interpretation. It is not, Japan could sell $1 trillion of treasuries and nothing bad would happen. The lesson is more specific. Gradual, orderly selling can be absorbed if the seller is not forced by their own financial pressures to sell rapidly, if adequate alternative buyers are available, and if the selling doesn't coincide with other financial system stresses that reduce buyer capacity. The Japanese scenario is specifically concerning because the specific combination of yield curve control, unwinding, carry trade reversal, and the potential for disorderly yen appreciation could produce selling that is neither gradual nor orderly. Chapter 6. Japan's Domestic Calculations. Why selling U.S. bonds might be rational. Here's the chapter that examines the specific decision calculus from Japan's perspective. The specific domestic financial pressures, institutional incentives, and policy considerations that might rationally lead Japan to reduce its U.S. Treasury holdings, independent of any desire to harm the American economy. This is the crucial framing shift that makes the Japanese scenario genuinely frightening. Japan doesn't need to want to damage the American economy. Japan just needs to make the rational financial decisions that its own domestic situation is increasingly demanding. And those rational decisions are the specific actions that would produce severe stress in the U.S. Treasury market. The Japanese pension fund calculus, the largest pool of capital in the world. Here's the specific institutional actor that would be most rational in reducing U.S. Treasury holdings as Japanese domestic yields rise. The Government Pension Investment Fund of Japan, or GPIF, which manages approximately $1.5 trillion in assets and is the largest pension fund in the world. The GPIF manages the retirement savings of the Japanese public, a mandate that requires it to generate returns sufficient to meet the pension obligations of Japan's aging population. Its investment strategy is driven by specific return requirements and specific risk constraints that are responsive to changes in the domestic investment landscape. The GPIF's current asset allocation includes a significant allocation to foreign bonds, primarily U.S. Treasury bonds, held in part because Japanese domestic bond yields were too low to generate the returns required to meet pension obligations. The specific financial logic, when the alternative is Japanese bonds yielding 0%, U.S. Treasuries at 4% to 5% are enormously more attractive despite the currency risk and the hedging costs, as Japanese domestic bond yields rise from near 0 toward 1% and potentially 2%. The specific attractiveness of U.S. Treasury bonds relative to Japanese bonds declines. The GPIF's mandated return target, approximately 4.0% nominal, becomes achievable with a higher domestic bond allocation as Japanese yields rise, reducing the specific financial necessity of holding U.S. Treasury bonds that are subject to currency risk and hedging costs. The GPIF is not going to sell its U.S. Treasury holdings overnight. Its investment policy changes are deliberate, publicly communicated, and gradual, but the directional pressure, increasing domestic allocation as domestic yields rise, reducing foreign bond allocation as the return advantage narrows, is the specific rational response to changing domestic financial conditions that the GPIF's investment mandate implies. The scale of potential GPIF Treasury allocation reduction, even a 5 percentage point reduction in the GPIF's foreign bond allocation from approximately 25% of assets to 20%, would represent approximately $75 billion of Treasury selling. A 10 percentage point reduction would represent approximately $150 billion. These are not trivial quantities in the context of the Treasury market's normal functioning. The life insurance company calculus, the duration mismatch problem. Here's the second major Japanese institutional actor with specific financial incentives to reduce U.S. Treasury holdings. The major Japanese life insurance companies that collectively hold significant quantities of U.S. bonds as part of their asset liability management strategies. Japanese life insurance companies, Nippon Life, Dai-ichi Life, Meiji Yasuda Life, and others, manage enormous pools of assets representing the long-term savings of Japanese households. These institutions have specific liability structures, the long-term insurance policies and annuity obligations they have written, that require them to hold assets generating returns sufficient to meet those obligations over multi-decade time horizons. The specific financial pressure that rising Japanese domestic yields creates for life insurance companies. As Japanese government bond yields rise, the discount rate applied to their yen-denominated liabilities rises, reducing the present value of those liabilities. Simultaneously, the return on new Japanese government bond investments rises, improving the yield available on assets matched to those liabilities. The life insurance company that can now earn 1.5% on Japanese government bonds, compared to essentially zero previously, has a stronger case for matching its yen liabilities with yen assets, reducing the currency and hedging costs associated with foreign bond holdings. The specific hedging cost dynamic described in Chapter 3 is particularly relevant for life insurance companies. The currency hedging costs that convert U.S. Treasury returns into yen terms consume most or all of the yield differential when Japanese rates are rising. Life insurance companies that have been bearing hedging costs to hold U.S. Treasuries will find the net return on hedged U.S. Treasuries approaches or drops below the return on unhedged Japanese government bonds as Japanese rates rise, at which point the rational financial decision is to sell the U.S. Treasuries and buy Japanese bonds. The Bank of Japan's own holdings, the 800-pound gorilla. Here's the most significant and most complex part of the Japanese Treasury situation. the Bank of Japan's own holdings of US dollar assets through Japan's foreign exchange reserves, which are managed by the Ministry of Finance and represent a separate but related dimension of the bilateral financial relationship. Japan holds approximately $1.25 trillion in foreign exchange in reserves, the world's second largest reserve pool after China. These reserves are managed to support currency market interventions. The Bank of Japan's ability to buy yen and sell dollars when the yen depreciates excessively is dependent on having adequate dollar reserves to sell. Japan has already used its foreign exchange reserves for significant currency market interventions during periods of acute yen weakness, spending approximately $60 billion in September 2022 and additional sums in subsequent intervention episodes in 2023 and 2024 to purchase yen and defend against excessive depreciation. Each currency market intervention that involves selling dollars and buying yen is, in the specific financial sense, a sale of dollar-denominated assets, including U.S. Treasury bonds. The scale of interventions required to defend the yen against the depreciation pressure from the yield differential has been significant, and the specific dynamic where yen weakness drives. Intervention that drives Treasury selling is a circular mechanism that has already been operating. The political economy of the decision. Why Tokyo cares about Washington's reaction. Here's the specific political constraint that makes the Japanese Treasury scenario more gradual and more manageable than the pure financial analysis might suggest. The specific political relationship between Japan and the United States that gives Tokyo significant reason to avoid actions that would be perceived as deliberately damaging to the American economy. Japan is a treaty ally of the United States. The U.S.-Japan Security Alliance, which provides Japan with the nuclear umbrella and conventional military partnership that Japan's constitution and domestic politics make essential for its security in a dangerous neighborhood, is the specific strategic relationship that Japan most depends on and most values. Deliberate disruption of the U.S. Treasury market, even if financially motivated, would be perceived in Washington as an unfriendly act with potential consequences for the security relationship that Japan cannot afford to jeopardize. This political constraint is real and important. It means that the Japanese scenario is almost certainly more gradual and more manageable than the financial analysis of rapid forced selling would suggest. Japanese financial institutions and the Japanese government are aware of the political sensitivity of their treasury holdings and manage that sensitivity carefully. But, and this is the specific qualification that makes the political constraint less reassuring than it initially appears, financial institutions do not have the primary obligation to manage bilateral political relationships. Japanese pension funds and life insurance companies have fiduciary obligations to their beneficiaries that legally require them to act in the financial interest of those beneficiaries. If Japanese domestic bonds provide superior risk-adjusted returns to U.S. Treasuries on a hedged basis, the fiduciary obligation of Japanese institutional managers may ultimately override the political preference for maintaining U.S. Treasury holdings. The political constraint slows the adjustment. It does not prevent it, and the specific scenario where the adjustment is accelerated by market forces, a yen appreciation episode, a Japanese economic shock, a global financial stress event that forces institutional risk reduction, is the scenario where the political constraint is weakest and the financial imperative is strongest. Chapter 7. The dollar's vulnerability, how Japanese selling threatens reserve currency status. Here's the chapter that elevates the Japan-US Treasury scenario from a bond market problem to a potential challenge to the foundational architecture of the global financial system. The specific ways in which large-scale Japanese treasury selling would interact with the dollar's reserve currency status, and potentially accelerate the erosion of that status in ways that would have consequences far beyond the immediate treasury yield impact. The dollar's reserve currency status is the specific financial privilege that allows the United States to run the persistent trade and fiscal deficits described in earlier chapters without experiencing the currency crisis that would destroy any other country in the same fiscal position. Understanding why Japanese selling threatens this privilege and what the loss of that privilege would mean is essential to understanding the full scope of the risk this video is describing. The exorbitant privilege, what reserve currency status actually provides. Here's the specific economic benefit that the dollar's reserve currency status provides to the United States: the exorbitant privilege that French Finance Minister Valéry Giscard d'Estaing coined in the 1960s, and that remains the most accurate short description of what the dollar's global role provides. Reserve currency status means that the dollar is the currency in which international trade is predominantly invoiced, in which global commodity markets are denominated, and in which foreign governments and central banks hold the majority of their reserve assets. This global demand for dollars to facilitate trade, to hold as reserves, to price commodities, creates a persistent, large-scale demand for dollar-denominated assets that has no equivalent for any other currency. The specific economic privilege this provides, the United States can run perpetual trade deficits without currency crisis because the dollars that flow out of the U.S. economy to pay for imports flow back in as demand for dollar assets, primarily U.S. Treasury bonds. The American consumer who buys a Japanese car sends dollars to Japan. Japan uses those dollars to buy U.S. Treasury bonds. The U.S. government uses the proceeds of those Treasury sales to fund the spending that includes, among other things, the defense commitments that keep Japan safe. The circular flow is the specific financial architecture of the post-war global order. If Japan reduces its Treasury bond purchases and sales, even gradually, even for purely domestic financial reasons, the specific circular flow is interrupted. The dollars that flow to Japan through trade still flow, but they return to the United States in reduced quantities through Treasury bond purchases. The gap between dollars leaving the U.S. and dollars returning as Treasury demand is the gap that must be filled by either domestic buyers, other foreign buyers, or Federal Reserve money creation, each of which has specific costs and limitations. The dollar index impact. The currency consequences of Treasury selling. Here's the specific mechanism through which large-scale Japanese Treasury selling would affect the dollar's exchange rate. The currency market dynamics that would accompany the bond market, stress described in Chapter 4. When Japanese investors sell U.S. Treasury bonds, they receive dollars. If those dollars are then converted to yen, either because the investors are repatriating the capital to invest in Japanese assets, or because they are unwinding yen carry trade positions, the conversion involves selling dollars and buying yen. Large-scale dollar selling and yen buying produces dollar depreciation and yen appreciation. The dollar's exchange rate is itself a critical variable in the reserve currency dynamic. A depreciating dollar makes dollar-denominated assets less attractive to foreign investors in their home currency terms, which reduces the demand for U.S. treasuries from all foreign investors, not just Japanese ones. The specific feedback loop: Japanese selling drives dollar depreciation, which reduces the attractiveness of treasuries to all foreign investors, which reduces demand for treasuries, which pushes yields higher, which attracts some additional buying, but also signals dollar weakness, which further reduces foreign investor confidence in dollar assets. This feedback loop has operated in previous episodes of dollar weakness, most notably in the late 1970s, when the combination of inflation and fiscal deficits produced a dollar crisis that required emergency intervention, including emergency currency swap lines with foreign central banks and the specific Carter bonds, U.S. Treasury bonds denominated in foreign currencies rather than dollars, a specific admission that dollar denomination was no longer sufficient to attract adequate buyers. The scenario where dollar weakness from Japanese treasury selling reinforces itself through the feedback loop described above is the specific pathway from a bilateral Japan-US financial adjustment to a broader dollar confidence crisis, the scenario that the financial community describes as the most severe version of the Japan risk, and that most analysts still characterize as low probability but genuinely non-negligible. The alternative reserve asset question: what fills the dollar's role? Here's the specific question that the Japan scenario raises at the systemic level. If the dollar's reserve currency status is eroding, what fills the role that the dollar currently plays in the global financial system? The honest answer is that there is no obvious, readily available alternative. The euro, the yen, the yuan, the Swiss franc, the British pound, each has specific limitations that have prevented it from challenging dollar dominance despite the United States' persistent fiscal deficits and the political use of dollar financial system access as a sanctions weapon. The yuan's specific limitations: China's capital account is not fully open, which limits the global circulation of yuan and reduces its utility as a reserve currency. China's financial markets lack the depth and the institutional credibility, the independent judiciary, the rule of law, protections for property rights, that investors require to hold a currency as a reserve asset. The euro's specific limitation: the eurozone lacks the unified fiscal authority that would make euro-denominated sovereign debt genuinely comparable to U.S. treasuries. European safe assets are politically constrained by the preferences of fiscally conservative member states that have resisted the creation of jointly guaranteed eurozone bonds. Gold's specific limitation: the global economy has grown far beyond the scale that the fixed gold supply could support as a monetary anchor without the deflation that a return to gold standards historically produces. The specific implication of the absence of a clear alternative: the reserve currency transition, if it occurs, is unlikely to be the clean replacement of the dollar with a specific alternative. It is more likely to be the messy, disorderly fragmentation of the dollar-based system into a multipolar system, multiple reserve currencies playing regional roles, with the specific economic costs of that fragmentation distributed unevenly across the global economy, with the United States bearing a disproportionate share in the form of higher borrowing costs and reduced fiscal flexibility. Chapter 8: The Federal Reserve's Impossible Response Between Inflation and Financial Crisis. Here's the chapter that addresses the specific policy dilemma that Japanese treasury selling would create for the Federal Reserve. The specific impossible position between two deeply undesirable responses that the combination of large-scale treasury selling and the existing inflation environment would produce. The Federal Reserve's dual mandate, maximum employment and price stability, is already being tested by the current economic environment. The Japan scenario adds a third implicit objective: financial stability, specifically the orderly functioning of the treasury market, that would create a specific three-way conflict among policy objectives that the Fed's existing tools are not designed to resolve simultaneously. The three-way policy conflict. Here's the specific policy conflict that the Japan scenario creates: the three simultaneously incompatible policy requirements that Japanese treasury selling would impose on the Federal Reserve. Requirement 1: controlling inflation. The Federal Reserve has committed to returning inflation to its 2% target. This commitment requires maintaining interest rates at levels that restrict economic demand, rates that are, by definition, above the neutral rate that neither stimulates nor restricts growth. Cutting rates to offset the financial tightening from Japanese treasury selling would risk reigniting inflation at a moment when the inflation battle is not fully won. Requirement 2: preventing treasury market dysfunction. If Japanese selling drives treasury yields to levels that produce genuine market dysfunction, the specific scenario where the treasury cannot conduct its auctions at manageable yields and the entire financing of the U.S. government is threatened, the Federal Reserve would face enormous pressure to intervene with emergency treasury purchases, as it did in March 2020 when treasury market functioning was severely impaired during the COVID panic. Requirement 3: maintaining dollar credibility. The emergency treasury purchases that would prevent market dysfunction would require the Federal Reserve to expand its balance sheet, to create new dollars to purchase the treasury bonds that Japan is selling. Creating new dollars in an environment of elevated inflation is the specific action that would most severely damage dollar credibility and most accelerate the reserve currency erosion described in Chapter 7. The specific impossibility preventing treasury market dysfunction requires expanding the balance sheet, which undermines dollar credibility and potentially reignites inflation. Maintaining anti-inflation credibility requires not expanding the balance sheet, which allows treasury market dysfunction to worsen. Maintaining all three simultaneously is not possible with the tools the Federal Reserve has available. The specific scenarios: from gradual adjustment to acute crisis. Here's the specific range of scenarios that the Japan situation could produce and the Federal Reserve's likely response to each, from the manageable to the genuinely difficult. Scenario 1: gradual portfolio adjustment over multiple years. Japanese institutional investors gradually reduce U.S. Treasury holdings over 5 to 10 years as Japanese domestic yields rise to levels that make domestic investment more attractive. The Treasury market absorbs the selling through gradual yield adjustments and the development of alternative buyer pools. the Federal Reserve adjusts its communication and policy framework to accommodate the gradually tightening financial conditions. This is the most probable scenario and the most manageable, painful in its effects on borrowing costs but not catastrophic. Scenario 2, accelerated selling driven by yen appreciation, a significant yen appreciation episode driven by carry trade unwinding, a global risk-off event, or an unexpectedly aggressive Bank of Japan rate increase, produces rapid, forced Japanese treasury selling as carry trade positions are unwound simultaneously. Treasury yields spike quickly, 0.5 to 1.5 percentage points in weeks rather than months. The Federal Reserve faces the immediate crisis response decision, intervene with emergency purchases, and risk the inflation and credibility consequences, or allow the market dislocation to run its course and risk the economic consequences of a rapid tightening of financial conditions. Scenario 3, fiscal crisis interaction. The Japanese selling coincides with a U.S. fiscal crisis, a specific debt ceiling standoff, a credit rating downgrade, a CBO projection that triggers investor concern about U.S. fiscal sustainability, that reduces the domestic buyer base for treasuries simultaneously with the Japanese selling. The combination of reduced foreign buying and reduced domestic buying at a moment of increased treasury issuance produces the specific auction failure scenario described in Chapter 4. This scenario has the lowest probability, but the most severe consequences. The credibility destruction scenario, when the cure is worse than the disease. Here's the specific scenario where the Federal Reserve's response to the Japan situation produces more damage than the initial selling would have created. The credibility destruction scenario, where emergency bond purchases in an inflationary environment signal that the Federal Reserve will always prioritize financial stability over price stability. The Fed's anti-inflation credibility is one of its most valuable assets. The specific expectation that the Federal Reserve will maintain policy tight enough to restore 2% inflation, even at the cost of economic pain, is what prevents inflation expectations from becoming unanchored. Unanchored inflation expectations, the specific situation where households and businesses no longer believe the central bank will restore price stability, produce the wage price spirals and persistent inflation that are the most damaging and most difficult to reverse economic outcomes available. If the Federal Reserve announces emergency treasury purchases in response to Japanese selling while inflation remains above target, it would be signaling that its commitment to price stability is conditional, that there exists a specific financial market stress threshold at which the inflation fight is suspended. This signal would immediately and permanently change market participants' assessment of the Fed's anti-inflation credibility, producing the inflation expectations problem that makes restoring price stability significantly more difficult and significantly more economically costly. The specific historical analog is the Bank of England's September 2022 episode, where the Bank of England announced emergency gilt purchases on the same day it had communicated its intention to continue tightening monetary policy. The contradiction was obvious to every market participant and damaged the bank's credibility in ways that took months to repair. The Federal Reserve faces the same potential credibility contradiction in the Japan scenario, but at a larger scale and with larger global consequences given the dollar's reserve currency role. Chapter 9. The Contagion Channels, How Japanese Selling Affects the Rest of the World. Here's the chapter that expands the geographic scope of the analysis. The specific mechanisms through which large-scale Japanese treasury selling would spread beyond the bilateral US-Japan financial relationship to affect the global economy in ways that would feed back into the US economy through the specific channels of international trade, capital flows, and financial market interconnectedness. The global financial system is not a collection of independent national financial systems that happen to be located in proximity to each other. It is a deeply interconnected web of capital flows, currency relationships, and financial asset cross-holdings that transmit financial stress across borders with remarkable speed and sometimes with remarkable amplification. The emerging market impact, the first casualties. Here's the first global contagion channel, the specific mechanism through which rising U.S. Treasury yields from Japanese selling would produce economic and financial crisis in emerging market economies around the world. Emerging market economies, Brazil, India, Indonesia, South Africa, Turkey, Mexico, and dozens of others, borrow in dollars, Their governments issue dollar-denominated bonds, their corporations borrow in dollars. Their financial systems hold dollar-denominated assets as reserves. This dollar dependency makes them specifically vulnerable to any development that raises U.S. Treasury yields or strengthens the dollar, and Japanese Treasury selling produces both simultaneously. The specific transmission: rising U.S. Treasury yields attract capital flows from emerging markets to dollar assets as investors seek higher returns in the world's largest, most liquid market. Capital outflows from emerging markets produce currency depreciation in those markets. The local currency weakens against the dollar. The weaker local currency makes dollar-denominated debt more expensive to service in local currency terms. A Brazilian company that borrowed $100 million at a time when the Brazilian real was 5 per dollar is paying the dollar equivalent of more reais when the real depreciates to 6 per dollar. At some level of depreciation, the debt service burden becomes unsustainable and defaults occur. The emerging market financial crisis dynamic has occurred multiple times in the context of rising U.S. rates: the 1994 tequila crisis in Mexico, the 1997 Asian financial crisis, the 2013 taper tantrums, emerging market disruptions, and the 2022 emerging market currency pressures from the Fed's rate increases. Japanese selling-driven Treasury yield increases would produce the same dynamic, with the potential for larger scale given the magnitude of potential selling. The European impact: the sovereign debt stress revival. Here's the second contagion channel: the specific mechanism through which rising U.S. Treasury yields would transmit financial stress to European sovereign debt markets, particularly in the peripheral Eurozone countries whose debt sustainability is most sensitive to the global interest rate environment. The European sovereign debt crisis of 2010 to 2012, the specific episode where Italian, Spanish, Portuguese, and Greek government bond yields spiked to levels that threatened the fiscal sustainability of those governments, was resolved in substantial part by the European Central Bank's commitment to unlimited bond purchases under Mario Draghi's famous "whatever it takes" commitment. That commitment created the specific expectation that the ECB would prevent Eurozone sovereign bond yields from rising to crisis levels. An expectation that has been tested multiple times since, and that depends fundamentally on the ECB's ability to purchase sovereign bonds without triggering the inflation that such purchases risk. In an environment where Japanese selling has driven global risk-free rates higher and has created doubt about the credibility of central bank anti-inflation commitments, the European periphery sovereign debt premium, the yield spread between Italian or Spanish government bonds and German bonds would likely widen, raising the borrowing costs of already stressed governments and potentially reviving the existential questions about Eurozone fiscal sustainability that the Draghi era temporarily resolved. The specific feedback to the U.S. economy: European financial system stress is transmitted to U.S. financial markets through the deep interconnectedness of global banks, the cross-border holdings of financial institutions, and the risk appetite reduction that any major financial center's stress produces globally. The Asian financial system impact: Japan's regional interconnectedness. Here's the third contagion channel: the specific impact of the Japan scenario on the Asian financial system, where Japan's financial relationships with regional economies create specific transmission pathways for the domestic financial stress that yield curve control unwinding produces. Japan is deeply financially integrated with the rest of Asia. Japanese banks are among the largest lenders in multiple Asian economies. Japanese institutional investors hold significant quantities of Asian bonds and equities alongside their U.S. Treasury positions, and the yen's role as a regional funding currency for carry trades involves multiple Asian emerging markets as the destination for the yen-funded investment. A significant yen appreciation from carry trade unwinding, the dynamic described in Chapter 3, would specifically affect Asian economies where yen-funded investment has been significant. The unwinding of yen-funded positions in Asian emerging markets produces capital outflows from those markets with the currency and financial stability consequences described above. Japan's financial crisis transmits to Asia before it fully transmits to the United States, and Asia's financial instability feeds back to the United States through trade, financial market sentiment, and the risk appetite reduction that regional financial crises produce. Chapter 10: The U.S. Response Options: What Washington Can Actually Do. Here's the chapter that examines the specific policy tools. Available to the United States to manage the Japan scenario, the responses that Washington could deploy to mitigate the Treasury market impact of large-scale Japanese selling, and the honest assessment of each response's effectiveness, costs, and limitations. Because the Japan scenario, for all its severity, is not a situation in which the United States is completely without agency. There are specific policy responses available, some more credible and effective than others, some that create more problems than they solve, and some that represent genuine diplomatic and financial innovation that could change the dynamic substantially. Option 1. Currency swap lines and bilateral financial cooperation. Here's the first and most immediately available policy tool, the bilateral financial cooperation mechanisms that the US and Japan already have in place and that could be expanded and adapted to manage an acute Treasury market stress event. The Federal Reserve maintains currency swap lines with the Bank of Japan, arrangements that allow the Bank of Japan to access dollars in exchange for yen, providing dollar liquidity to the Japanese financial system when it is under stress. These swap lines have been used during previous financial stress events, most notably during the 2008 financial crisis and the March 2020 COVID disruption, to prevent dollar shortages from amplifying financial system stress. In the Japan scenario, expanded swap line arrangements could provide a specific mechanism for managing the dollar-yen dynamics of the carry trade unwind. The Bank of Japan could use dollar swap access to provide yen liquidity that stabilizes the currency without requiring direct intervention in the foreign exchange market through treasury sales. This would reduce the specific pressure from carry trade unwinding without producing the treasury selling that drives the yield impact. The limitation: currency swap lines address the liquidity dimension of the Japan scenario, the acute dollar shortage that carry trade unwinding can produce, but do not address the fundamental financial incentive that makes Japanese treasury selling rational as domestic yields rise. Solving the liquidity problem does not solve the portfolio reallocation problem. Option 2. Fiscal consolidation, the real solution that nobody wants. Here's the most effective and least politically viable response to the Japan scenario: the reduction of U.S. government deficit spending that would reduce the supply of treasury bonds in the market and therefore reduce the market sensitivity to changes in Japanese demand. The fundamental dynamic that makes Japanese treasury selling dangerous is the combination of very large treasury supply. The U.S. government is issuing approximately $2 trillion in new debt annually to fund its deficit, and the potentially shrinking buyer base as Japanese selling reduces foreign demand. Reducing the supply of new treasury issuance through fiscal consolidation, spending reductions, revenue increases, or some combination, would directly address the supply-demand imbalance that large-scale Japanese selling would create. The specific mathematics: if the U.S. reduced its annual deficit by $500 billion from approximately $2 trillion to $1.5 trillion, it would issue $500 billion less in new treasuries annually. This supply reduction would partially offset the demand reduction from Japanese selling, reducing the yield adjustment required to clear the market. The political reality: reducing the U.S. deficit by $500 billion would require either dramatic spending cuts, which would affect Social Security, Medicare, defense, or the full range of discretionary spending programs, or significant tax increases, or some combination. The specific political coalition required to pass either has not existed in Washington for decades. The deficit reduction solution to the Japan problem is the correct long-term answer and the specific policy change that would most durably address the vulnerability. And it is the response least likely to be implemented in the time frame that the Japan scenario demands. Option 3. Developing alternative buyer pools, the structural response. Here's the third response option: the deliberate development of alternative buyer pools for U.S. Treasury bonds that would reduce dependence on Japanese institutional demand and make the Treasury market more resilient to changes in Japanese buying behavior. The specific alternative buyer pools that U.S. Treasury market policy could develop: domestic pension fund and insurance company investment in treasuries through regulatory and tax incentive changes that make Treasury investment more attractive to these institutions; sovereign wealth fund partnerships with Gulf state investors who have the scale and the long-term investment orientation to absorb significant Treasury supply; international development institution investment in U.S. Treasuries as reserve assets, expanding the institutional base beyond central banks to include multilateral financial institutions. The limitation: developing genuinely significant alternative buyer pools takes time, measured in years, not months, and the specific financial incentives that would attract alternative buyers are themselves constrained by the fiscal situation. Buyers want adequate yields. Adequate yields mean higher government borrowing costs. Higher borrowing costs worsen the fiscal situation. The alternative buyer development strategy is directionally correct, but operationally slow relative to the pace at which the Japan situation could develop. Option 4. The Plaza Accord 2.0, the geopolitical negotiation option. Here's the most ambitious and most geopolitically complex response option: a negotiated bilateral agreement between the United States and Japan on the management of yen-dollar exchange rates and the pace of Japanese financial policy normalization, analogous to the Plaza Accord of 1985, but operating in the reverse direction. The Plaza Accord forced yen appreciation to address the U.S. trade deficit with Japan. A Plaza Accord 2.0 would seek to manage yen appreciation and the pace of Japanese treasury selling to prevent a disorderly treasury market adjustment, essentially asking Japan to normalize its monetary policy more gradually than its domestic situation demands, in exchange for specific U.S. concessions on the economic or security relationship. The United States has leverage in this negotiation. The security relationship that Japan depends on for its defense against China and North Korea creates specific diplomatic bargaining capacity that has been used to manage bilateral economic tensions throughout the post-war period. Japan has leverage, the $1.1 trillion in treasuries it holds, and its ability to accelerate or decelerate the pace of normalization is a specific financial reality that Washington cannot ignore. A negotiated management of the normalization pace, Japan commits to gradual, predictable treasury portfolio adjustment in exchange for specific U.S. commitments on security cooperation, trade relationships, or financial cooperation, is the specific diplomatic outcome that would produce the most orderly resolution of the bilateral financial tension. Whether the political will exists on both sides to negotiate such an arrangement before a crisis forces, it is the specific question that the next several years will answer. Chapter 11. The investment implications. How to think about your portfolio in the Japan scenario. Here's the chapter that translates the macroeconomic and geopolitical analysis of the previous chapters into the specific investment implications for the individual investor who wants to understand how the Japan scenario affects their portfolio and what specific adjustments, if any, the scenario warrants. Let's be clear about the framing from the beginning. This chapter is not about predicting that the Japan scenario will materialize in its most severe form. It is about understanding the specific portfolio exposures that the Japan scenario would affect most severely, and the specific adjustments that would provide meaningful protection against those exposures without sacrificing the expected return from the base case scenario, where the normalization proceeds gradually and manageably. The interest rate duration risk, the most direct portfolio. Impact. Here's the specific portfolio exposure that the Japan scenario most directly threatens: the interest rate duration risk in fixed income portfolios. Duration is the specific measure of a bond's sensitivity to interest rate changes. A bond with a duration of 10 years loses approximately 10% of its price for each 1 percentage point increase in yields. The 10-year Treasury bond, the benchmark instrument whose yield is most directly affected by Japanese selling, has a duration of approximately 9 years. A 1 percentage point increase in 10-year Treasury yields from Japanese selling pressure would reduce the price of 10-year Treasury bonds by approximately 9%. The specific portfolio protection adjustments, reducing the duration of fixed income holdings, shifting from long-term bonds to short-term bills and notes, reduces the sensitivity of the fixed income portfolio to the yield increases that Japanese selling would produce. The investor who holds a portfolio concentrated in long-term Treasury bonds has specific, large exposure to the Japan scenario's most direct financial impact. The investor who has shifted the fixed income portfolio toward shorter durations, 2-year notes, Treasury bills, short-duration bond funds, has reduced that specific exposure substantially. The trade-off, Shorter duration fixed income generally yields less than longer duration fixed income in a normal yield curve environment, representing a return sacrifice in exchange for reduced duration risk. The specific question for each investor is whether the Japan scenario risk and the specific portfolio damage it would produce through long duration bond price declines is sufficient to justify the yield sacrifice of shorter duration. The equity valuation risk, the indirect but significant impact. Here's the second specific portfolio impact of the Japan scenario, the equity valuation reduction that rising treasury yields would produce through the discount rate mechanism described in Chapter 4. As treasury yields rise from Japanese selling pressure, the discount rate applied to future corporate earnings rises, reducing the present value of those earnings, and therefore reducing the theoretically appropriate equity valuation. The specific portfolio impact depends on the equity allocation's composition. Growth stocks, with earnings heavily weighted toward the distant future, are more sensitive to discount rate increases than value stocks with near-term earnings, but the directional impact is negative for equities broadly. The specific portfolio adjustment for equity investors, a modest shift from the most expensive, most rate-sensitive equity exposures, the large-cap growth stocks with extremely high price-to-earnings ratios, whose valuations most depend on low discount rates, toward value-oriented dividend-paying equities whose valuations are less sensitive to the specific discount rate increases that the Japan scenario produces. International diversification, including non-U.S. equities whose valuations are less dependent on U.S. interest rate levels, provides additional protection against the specific U.S. market valuation impact. The real asset hedge, the inflation and rate protection. Here's the third specific portfolio adjustment relevant to the Japan scenario, the addition of real asset exposure that provides specific protection against the inflation scenarios that the Japan scenario amplifies. The specific real assets with the most direct relevance, Treasury Inflation Protected Securities, TIPS, whose principal adjusts with inflation and whose real yield remains positive in an inflationary environment, even as nominal yields rise. Commodity exposure, through commodity index funds or energy sector equities, that benefits from the oil price spikes and general commodity inflation that the geopolitical scenarios amplifying the Japan situation would produce. Real estate investment trusts, though with careful attention to the interest rate sensitivity of REIT valuations, which are negatively affected by rising yields in the near term, even if the long-term inflation protection is valuable. The dollar diversification question, currency risk in the Japan scenario. Here's the fourth portfolio consideration, the specific question of whether the dollar depreciation risk from the Japan scenario warrants explicit currency diversification in the investment portfolio. The Japan scenario's specific dollar weakness dynamic, Japanese selling drives yen appreciation and dollar depreciation, creates a specific environment where dollar-denominated assets lose value in other currency terms. For U.S. investors whose liabilities are entirely in dollars, this might seem irrelevant, but dollar depreciation has specific domestic economic consequences. Imported goods become more expensive, energy prices rise as dollar weakness amplifies commodity price increases, and the inflation that results from dollar weakness erodes the real purchasing power of dollar-denominated assets. The specific currency diversification tools available to individual investors, international equity funds denominated in local currencies provide implicit currency diversification. The returns include both the equity returns and the currency returns, which benefit from dollar depreciation relative to the currencies of the countries where the equities are domiciled. Gold provides explicit currency diversification as an asset that is denominated in no single currency and that has historically appreciated in dollar terms during periods of significant dollar weakness. Chapter 12. The Timeline. How this actually unfolds. Here's the chapter that attempts the most difficult analytical task in the entire video. The construction of a realistic timeline for how the Japan scenario might actually unfold from the current state of progressive Bank of Japan policy normalization through the potential inflection points that could accelerate the adjustment to the specific endpoints that represent different resolution scenarios. The honest acknowledgement up front, timelines and macroeconomic forecasting are notoriously unreliable. The specific events that accelerate or decelerate the normalization, a Japanese domestic recession, a global financial crisis, a geopolitical shock, a Bank of Japan leadership change, are not predictable with the precision that a specific timeline implies. The framework below is a scenario planning tool rather than a forecast. The near term, 2025 to 2027, the normalization continues. Here's the specific near-term trajectory that the current policy direction implies, the path of gradual Bank of Japan normalization that is already underway, and that will continue absent a specific shock that reverses it. The Bank of Japan has raised its policy rate to approximately 0.5% and signaled its intention to continue raising rates gradually toward 1% to 1.5% over the next 2 to 3 years. 10-year Japanese government bond yields have risen to approximately 1% to 1.5% and are expected to continue rising gradually as the policy normalization proceeds. Japanese institutional investors, pension funds, life insurance companies are gradually increasing their domestic bond allocations as domestic yields make Japanese bonds more competitive with hedged foreign alternatives. The treasury market impact of this gradual normalization is real but manageable. The yield differential between U.S. and Japanese bonds narrows gradually, reducing the financial incentive for new Japanese investment in U.S. treasuries and motivating the gradual reallocation of existing holdings toward domestic assets. Treasury yields are pushed modestly higher by the reduced Japanese marginal demand, perhaps 0.25 to 0.5 percentage points above what they would be with continued Japanese buying, and the U.S. economy absorbs this modest tightening without acute crisis. This is the base case scenario. It is the most probable near-term outcome. It is also not a comfortable outcome. The modest additional yield increase compounds the affordability and corporate borrowing cost stresses already present in the economy, but it is manageable within the existing framework of monetary and fiscal policy. The medium term, 2027 to 2030, the critical period. Here's the specific medium-term period where the trajectory becomes most uncertain and where the specific inflection points that could produce the more severe scenarios are most likely to arise. By 2027 to 2030, several of the specific pressure points identified in this video are likely to be more acute. Japanese domestic rates will be significantly higher than today, assuming the normalization proceeds without reversal, making Japanese domestic bonds substantially more competitive with U.S. treasuries on a hedged basis. The U.S. fiscal situation will be more stressed. The Congressional Budget Office projects continued deficit expansion, making treasury supply larger and the market sensitivity to changes in demand greater. The specific dollar reserve erosion trend will be more advanced. The global de-dollarization that has been proceeding gradually will have reduced the structural foreign demand for treasuries further. The medium-term critical period is where the scenario tree branches most significantly. In the branch where global financial conditions remain relatively stable, U.S. fiscal policy makes meaningful progress towards sustainability, and Japanese normalization proceeds gradually, the adjustment remains manageable. In the branch where a global financial crisis, triggered by the Japanese carry trade unwind, by a Middle Eastern energy shock, by a European sovereign debt episode, or by some combination, produces the accelerated selling scenario, the medium-term period is where the acute crisis is most likely to occur. The longer term, the structural equilibrium. Here's the specific longer-term endpoint that the Japan scenario is ultimately moving toward: the structural equilibrium where the bilateral financial relationship has been reset to a new baseline that reflects Japan's normalized monetary policy and the United States' adjusted financing environment in the longer term, 5 to 10 years. The specific equilibrium that the Japan scenario resolves toward is one where Japanese institutional investors hold meaningfully less U.S. Treasury bonds than today. U.S. Treasury yields are meaningfully higher than they would have been without the Japanese portfolio reallocation. The U.S. government's interest costs are higher and the fiscal pressure more acute, and the dollar's reserve currency share of global reserves is modestly lower as the alternative reserve arrangements that multiple governments are developing mature. This endpoint is not the end of the dollar, not the collapse of the U.S. Treasury market, and not the destruction of the American economy. It is a specific, meaningful, permanent increase in the cost of the American economy's financial infrastructure, a higher baseline for interest rates, mortgage rates, corporate borrowing costs, and government debt service that represents the specific financial consequence of the dependency that has been building for 4 decades. The households and businesses that navigate this transition most successfully are the ones that have positioned for the higher rate environment, the ones with fixed rate long-term debt locked in at current rates, the ones with real asset exposure that benefits from inflation, the ones with diversified income streams that are less vulnerable to the economic slowdown that higher borrowing costs produce. Chapter 13. The Questions. Everyone is asking, the Japan U.S. Treasury FAQ. Here's the chapter that addresses the specific questions that the previous 12 chapters inevitably raise, the pointed, direct, sometimes uncomfortable questions that the analysis produces and that deserve honest answers, rather than the diplomatic hedging that most financial commentary applies to topics this consequential. These are the questions that people who have followed the argument carefully are asking right now. They deserve specific answers. Q. Is Japan actually going to sell all its treasury bonds at once? Isn't that nuclear option too dangerous for everyone? Here's the honest answer to the question that most dismissals of the Japan scenario rely on. The argument that Japan would never do anything so dramatic and so damaging to its own interests as a sudden, massive treasury liquidation. The argument is correct that a sudden, deliberate liquidation of Japan's entire treasury position would be economically irrational for Japan. The act of selling $1.1 trillion in treasury bonds in a compressed time frame would drive treasury prices so low and yields so high that Japan would receive dramatically less for the bonds than their current market value. The selling would destroy more value for Japan than it would for the United States, which is the specific financial reason that the nuclear option scenario is genuinely implausible. But here is the specific qualification that makes this reassurance incomplete. The scenario that is genuinely concerning is not the deliberate nuclear option. It is the specific scenario where Japanese selling is not entirely voluntary, where the combination of carry trade unwinding, institutional portfolio reallocation, and currency market dynamics produces selling that is larger and faster than any single decision maker intended. The carry trade unwind of August 2024 was not a deliberate policy decision by the Bank of Japan to damage the global financial system. It was the specific mathematical consequence of a modest interest rate increase interacting with the accumulated leverage of trillions of dollars in yen-funded positions. The selling was not a choice. It was the forced consequence of margin calls, hedge rebalancing, and risk limit breaches that the individual institutions had no option to ignore. The specific risk is therefore not deliberate nuclear option selling. It is the scenario where the interaction of the Bank of Japan's gradual, well-intentioned normalization with the accumulated leverage of the global financial system produces forced selling that is beyond any single actor's ability to control or prevent. That scenario is both more plausible than the deliberate attack and more difficult to prevent precisely because it doesn't require anyone to choose to do it. Q. Why hasn't this already happened? Japan has been normalizing policy for a while now. Here's the specific reason why the scenario has not yet produced the acute crisis that the analysis might suggest is imminent, the specific factors that have slowed the adjustment and why those factors may not persist indefinitely. The first factor, the Bank of Japan has been extraordinarily cautious in the pace of its normalization, the most gradual central bank tightening cycle of any major economy in the current global tightening environment. This caution is deliberate and rational, given the specific fragility of Japan's economy and the scale of potential global spillovers. The Bank of Japan is acutely aware that its policy decisions have global consequences that no other central bank faces to the same degree, and it has calibrated its communication and policy moves to minimize the market disruption from each individual step. The second factor, U.S. Treasury yields have remained high enough in the 4% to 5% range to maintain a meaningful yield differential with Japanese bonds, even as Japanese yields have risen. The differential has narrowed, but it has not yet narrowed to the specific level where hedged Japanese investors find no advantage in holding U.S. Treasuries over Japanese alternatives. The critical threshold, where the hedging costs consume the entire remaining differential, has not yet been crossed for the full range of Japanese institutional investors. The third factor, the yen carry trade has been partially but not fully unwound. The August 2024 episode unwound a significant fraction of the accumulated carry trade position, but the subsequent stabilization allowed new carry trade positions to be rebuilt as investors concluded the Bank of Japan would proceed slowly. The accumulated carry trade position remains large and remains the specific source of the forced selling risk that the August 2024 episode previewed. The factors that could accelerate the adjustment: a Bank of Japan rate increase that is larger or faster than markets expect, driven by Japanese inflation or yen weakness that demands a more aggressive response, a global financial stress event that triggers simultaneous risk reduction across the financial system, forcing carry trade liquidation, a U.S. fiscal development, debt ceiling crisis, credit rating downgrade, unexpectedly large deficit projection that reduces domestic treasury demand simultaneously with the reduction in Japanese demand. None of these accelerating factors is imminent. All of them are genuinely possible within a 2 to 5 year time frame. Q. Can't the Federal Reserve just print money and buy whatever Japan sells? Here's the specific question that many people ask when the Treasury selling scenario is presented. The argument that the Federal Reserve's ability to create unlimited dollars means it can simply purchase whatever Treasury bonds Japan sells, preventing any market impact. The Federal Reserve can indeed purchase Treasury bonds in unlimited quantities. This is the quantitative easing mechanism that it has deployed multiple times since 2008. And in the specific narrow sense of preventing Treasury market dysfunction, the scenario where no buyer is found for Treasury bonds at any price, the Fed's ability to be the buyer of last resort is genuine and significant. But the specific cost of this response in the current environment is the critical qualification. Purchasing Treasury bonds requires the Federal Reserve to create new dollars, to expand its balance sheet. Creating new dollars in an environment where inflation is already above the 2% target would be directly inflationary, adding to the money supply at precisely the moment that the inflation mandate requires restricting it. The specific constraint: the Federal Reserve cannot simultaneously purchase Treasury bonds to prevent yields from rising and maintain the anti-inflation credibility that requires keeping monetary conditions tight. Every dollar of Treasury bond purchases is a dollar of monetary easing that works directly against the inflation mandate. The Fed cannot buy Japan's Treasury sales and maintain its inflation-fighting posture. The two actions are mathematically incompatible. The historical evidence: the Bank of England tried exactly this in September 2022, purchasing gilts for financial stability reasons while simultaneously claiming to maintain its anti-inflation stance. The market saw through the contradiction immediately. The Bank of England's credibility was damaged, the pound sold off, and the emergency intervention's effectiveness was limited by the market's recognition that the bank was making mutually exclusive policy commitments. The Federal Reserve would face the same credibility problem in a larger and more consequential form. The market's recognition that the Fed is printing money to monetize Treasury debt, even if described as emergency financial stability measures, would produce the specific inflation expectations unanchoring that represents the most dangerous long-term economic outcome available. The cure would genuinely be worse than the disease in this specific instance. Q. What does this mean for the average American who doesn't own Treasury bonds? Here's the most important practical question: the specific relevance of this entire analysis to the person who doesn't follow bond markets, doesn't have a Bloomberg terminal, and just wants to know what this means for their actual financial life. The answer is specific and significant. The average American who doesn't own a single Treasury bond is profoundly affected by what Treasury yields do, because Treasury yields are the specific number from which every interest rate in the American economy is derived. The mortgage rate, if you are planning to buy a home, refinance a mortgage, or are currently paying a variable rate mortgage, the Treasury yield movement from Japanese selling pressure would directly increase your monthly housing cost. A 1 percentage point Treasury yield increase adds approximately $200 to $250 per month to the payment on a $400,000 mortgage. That is the specific personal financial impact of the Japan scenario on the household planning to finance a home purchase. The car loan rate, auto loan rates are priced at spreads above Treasury benchmarks. Higher Treasuries mean higher auto loan rates, adding hundreds of dollars to the total cost of a financed vehicle purchase. The credit card rates are influenced by the federal funds rate rather than directly by Treasury. yields, but the Federal Reserve's response to the economic slowdown from higher Treasury yields, or alternatively its inability to cut rates because of inflation concerns, keeps consumer credit expensive for longer. The retirement account. If you hold bond funds in your 401k or IRA, the price decline in those bond funds from rising yields is a direct reduction in your retirement savings balance. The interest rate duration risk described in Chapter 11 applies specifically to the bond portion of any retirement account. The job market. The corporate borrowing cost increases from higher Treasury yields, reduce business investment and hiring, producing the specific labor market softening that translates individual yield movements into employment consequences for the people who work in the affected businesses. The Japan scenario is not an abstraction for bond market specialists. It is a specific financial development that would be felt in the mortgage payment, the car payment, the credit card statement, the retirement account balance, and the job security of ordinary Americans who have never heard of yield curve control and would prefer to keep it that way. Q. Is there anything the U.S. could do right now to reduce this vulnerability? Here's the specific policy question that the analysis ultimately demands: the actionable response that would reduce the United States' vulnerability to the Japan scenario before it becomes acute. The most important vulnerability reduction is also the most politically difficult, meaningfully reducing the U.S. fiscal deficit to reduce Treasury supply and decrease the market's sensitivity to changes in foreign demand. Every $1 billion of deficit reduction is $1 billion less of Treasury that needs to be sold to someone, making the overall market less dependent on any single buyer's continued participation. The second vulnerability reduction is diplomatic, proactive, high-level engagement with Japanese financial authorities to manage the normalization pace and coordinate the adjustment in ways that minimize market disruption. The United States and Japan have the specific diplomatic infrastructure, the bilateral economic dialogues, the G7 and G20 frameworks, the Financial Stability Board, to conduct this coordination. Whether it happens before or after a market stress event is the specific question that depends on political will that has not yet been demonstrated. The third vulnerability reduction is structural, developing the domestic institutional investor capacity to absorb Treasury supply that is currently dependent on foreign buyers. Regulatory changes that make Treasury investment more attractive for U.S. pension funds and insurance companies, tax incentives for long-term domestic bond investment, and the development of new Treasury products, ultra-long-term bonds, inflation-linked bonds structured for domestic institutional demand, would all contribute to reducing the foreign buyer dependency that makes the Japan scenario so concerning. None of these solutions is fast. None of them is politically easy. All of them are genuine improvements over the current trajectory of doing nothing and hoping the relationship continues as it has. Chapter 14. What comes after? The new financial order that Japan's adjustment is helping build. Here's the final chapter, the one that steps back from the specific mechanics of the Japan-US Treasury relationship and asks the larger question that the entire analysis has been building toward. What does the financial world look like after the adjustment that Japan's policy normalization is forcing? And what specific opportunities and risks does that new financial order present? Because the Japan scenario is not only about what it breaks, it is also about what it builds, the specific new financial arrangements that the stress of the adjustment produces, the new equilibrium that eventually emerges from the disruption, and the specific position that individuals, businesses, and governments will find themselves in when the transition is complete. The death of the free lunch, the end of consequence-free deficit spending. Here's the most significant structural change that the Japan scenario is helping produce, the specific end of the era in which the United States could run perpetual large deficits without experiencing the market discipline that would confront any other borrower in the same fiscal position. The era of consequence-free American fiscal profligacy was always contingent. It depended on the specific combination of dollar reserve currency status, reliable foreign demand for Treasury bonds, and Federal Reserve accommodation that made the extraordinary U.S. fiscal position sustainable in a way that no economic theory fully explained. Japan's Treasury position was a specific and critical component of the architecture that made the contingency work. As Japan's Treasury holdings decline and the specific yield differential that produced them narrows, the architecture is changing. The U.S. Treasury market is discovering that buyer depth is finite, that there are specific prices at which buyers disappear and yields must rise to attract them. This market discipline is the specific financial mechanism that constrains every other borrower, and that the dollar's reserve currency status has allowed the United States to defer but not permanently avoid. The new financial order that the Japan adjustment is helping build is one where American fiscal decisions face more immediate and more direct market consequences, where the Treasury yield response to deficit expansion is faster and larger than it was in the era of reliable foreign demand. This is, in the specific long-term sense, a healthier financial arrangement than the one it replaces. The market discipline that discourages fiscal irresponsibility is a feature rather than a bug of a well-functioning financial system. But the transition to this healthier arrangement is the specific period of disruption and adjustment that this video has been describing. The multipolar reserve currency world, the new financial geography. Here's the second structural development that the Japan adjustment is contributing to: the gradual transition from the dollar-dominated unipolar reserve currency system to a multipolar system where multiple currencies and assets play reserve roles in different regions and for different purposes. The specific reserve currency alternatives that are developing as dollar dominance gradually erodes are not individually capable of replacing the dollar. None of them has the combination of market depth, institutional credibility, and political stability that would make a complete transition feasible. But collectively, the gradual expansion of non-dollar reserve holdings, more euros, more yuan in regional arrangements, more gold, more bilateral currency swap agreements, is reducing the structural demand for dollar assets that has supported the US's exceptional fiscal position. Japan's role in this transition is specific and significant. As Japan normalizes monetary policy and its institutions reduce U.S. Treasury holdings, the yen itself becomes a more viable reserve currency, the currency of a normalized, positive-rate economy rather than the carry trade funding currency of the zero-rate era. The yen's specific role in Asian regional finance may expand as Japanese monetary policy normalization makes yen-denominated assets genuinely competitive as reserve holdings. The specific investment implication of the multipolar reserve currency transition, greater currency diversification in investment portfolios, is genuinely valuable as a hedge against the dollar depreciation that the erosion of reserve demand would produce. The international equity allocation, the gold position, and the specific commodity exposures that provide inflation protection in a weakening dollar environment all gain attractiveness as the transition proceeds. The higher rate world, the new normal that Japan is accelerating. Here's the third structural development that the Japan adjustment is contributing to, and that represents the most directly important change for the daily financial lives of most people: the transition to a higher baseline interest rate environment that the combination of inflation, fiscal expansion, and reduced foreign bond demand is producing. The era of near-zero interest rates that characterized the 2000s was a specific historical episode, produced by the specific combination of post-2008 financial crisis damage, deflationary pressures from Chinese manufacturing integration into the global economy, and the extraordinary monetary policy accommodation that central banks deployed to prevent that combination from producing a prolonged depression. It was not a permanent new normal. It was a response to specific circumstances that are now changing, the higher rate world that is emerging, where short-term rates are above 2% even in the absence of inflation fighting, where long-term Treasury yields reflect the genuine supply-demand balance for government debt, rather than the artificial suppression of central bank intervention, is the specific financial environment that the Japan adjustment is helping to cement. Japanese policy normalization removes one of the specific forces that kept global rates artificially low: the enormous demand for U.S. Treasuries from Japanese investors seeking positive yields that domestic alternatives couldn't provide. As that demand normalizes, the equilibrium yield level is higher. The practical implication for every financial plan built during the zero-rate era, the financial planning assumptions, the 7% to 8% nominal return from a stock bond portfolio, the 30-year mortgage at 3%, the corporate bonds yielding 4%, that were calibrated to a zero-rate environment need to be recalibrated for a world where the risk-free rate is structurally higher. The good news is that higher rates mean higher returns on savings and fixed income. The bad news is that higher rates mean higher borrowing costs, lower equity valuations, and more expensive government debt service. The Japan-US relationship beyond finance. the strategic recalibration. Here's the final dimension of the post-adjustment world. The specific evolution of the Japan-US strategic relationship that the financial adjustment is both reflecting and influencing. The Japan-US relationship has always been multidimensional. Security, trade, technology, and finance all intertwined in ways that make any single dimension impossible to fully separate from the others. The financial dimension of the relationship, Japan's extraordinary treasury holdings, has been both a consequence of the security and trade relationship and a specific financial constraint on both parties' policy freedom. Japan has been financially constrained by its treasury holdings. The specific political sensitivity of those holdings has limited Japan's ability to use its financial position as leverage in bilateral economic negotiations, and the carry trade positions built on yen funding have created specific vulnerabilities in the Japanese financial system that reduce Japan's economic resilience. The United States has been financially constrained by its dependence on Japanese treasury demand. The specific fiscal freedom that reliable Japanese buying provided has reduced the political urgency of fiscal consolidation and created the specific vulnerability that this video has described. As the financial relationship normalizes, as Japan's treasury holdings decline toward a more conventional level, and the specific distortions of yield curve control unwind, both countries gain a degree of policy freedom that the distorted financial relationship has denied them. Japan can normalize its financial system without the zero-rate distortions that have suppressed returns and incentivized excessive risk-taking through the carry trade. The United States faces the specific fiscal discipline that its debt sustainability ultimately requires, not as a punishment imposed by Japan, but as the natural consequence of confronting the actual cost of its fiscal choices rather than the artificially suppressed cost that Japanese demand provided. The new financial order that emerges from the Japan adjustment is one where both parties operate with clearer financial constraints and cleaner incentive structures. It is also one where the transition period, the specific years of adjustment during which the old structure unwinds and the new one is established, is genuinely difficult and genuinely risky in the ways this video has described. The final word, what you should actually do with this information. Here's the most practically important conclusion this chapter and this entire video can offer, the specific actionable orientation that the Japan scenario implies for the person who has absorbed the analysis and wants to translate it into financial decisions. The Japan scenario is a reason to take the specific financial preparation steps that are prudent in any uncertain economic environment, not because the scenario will definitely materialize in its most severe form, but because the preparation is valuable across a range of outcomes and its cost is modest relative to its protection value. The fixed income duration reduction that protects against yield increases is valuable if the Japan scenario produces treasury yield spikes. It is also valuable if any other factor, U.S. fiscal stress, inflation persistence, reduced global bond demand from any source, produces the same treasury yield increases. The inflation protection that TIPS and real assets provide is valuable in the Japan scenario. It is also valuable in the inflation scenario, the oil price shock scenario, and the geopolitical stress scenario. The emergency fund and income diversification that provide resilience against economic downturns are valuable if the Japan scenario produces recession. They are also valuable if any other recession trigger operates. The preparation this video implies is not the Japan-specific preparation of a single scenario bet. It is the general financial resilience preparation that the cumulative weight of the risks described throughout this series of videos implies, preparation that is valuable across a range of adverse outcomes rather than optimized for any single one. The Japan scenario is the specific, largely unrecognized source of vulnerability that makes the broader preparation more urgent. It is the specific financial relationship that most Americans have never heard of, and that is quietly, politely, and with great financial rationality becoming less reliable. As the domestic conditions that produced it change, the most polite potential economic catastrophe in modern financial history is not a prediction. It is a process. It has been underway for several years. It will continue for several more, and the households, businesses, and investors who understand it clearly, who see the specific mechanism, the specific transmission channels, and the specific preparation steps, will navigate it with far less disruption than those who encounter it as a sudden, inexplicable shock. Japan is not about to destroy the American economy, but Japan is about to stop subsidizing it, and it turns out those are two very different things with surprisingly similar consequences. Conclusion. Let's bring the full picture into focus, honestly, specifically, and without either the comforting dismissal that the most important bond market relationship in the world couldn't possibly become a problem, or the catastrophist framing that Japan is deliberately plotting the destruction of the American economy from a quiet office in Tokyo. The honest picture is this: Japan became the largest foreign holder of U.S. Treasury bonds through a specific, decades-long accumulation of trade surpluses, domestic financial system fragility, and the deliberate yield differential that yield curve control created. The relationship was mutually beneficial for a long time. Japan got safe, higher-yielding assets for its enormous savings pool. The United States got a reliable, large-scale buyer for the debt it was continuously issuing to fund its persistent government deficits. Both sides found it convenient. Neither side thought very hard about what happened when the specific conditions that made it convenient changed. Those conditions are changing. The Bank of Japan is normalizing monetary policy for the first time in decades, raising rates because Japan's inflation reality and its political and economic sustainability have finally demanded the policy change that market forces have been pushing for years. Japanese interest rates are rising. The specific yield differential that made U.S. Treasury bonds attractive to Japanese institutional investors is narrowing. The financial logic that produced and sustained Japan's trillion-dollar Treasury position is reversing. The reversal is not a discrete event. It is a process, one that could take years in the orderly scenario and weeks in the disorderly one. The orderly scenario, gradual portfolio reallocation over multiple years as domestic yields rise, produces specific but manageable economic consequences for the United States. Somewhat higher Treasury yields, somewhat higher mortgage and corporate borrowing costs, somewhat greater pressure on the U.S. fiscal situation, painful in the accumulated sense, not catastrophic in any single episode. The disorderly scenario, a yen appreciation shock from carry trade unwinding, a Japanese domestic financial crisis, or a global risk event that forces rapid, simultaneous Japanese institutional selling, produces the acute treasury market stress that the historical precedents of the UK gilt crisis and the taper tantrum provide limited previews of. Treasury yields spike, mortgage rates spike, equity valuations compress. The Federal Reserve faces the impossible choice between its anti-inflation mandate and its financial stability function. The dollar's reserve currency credibility is tested in ways it has not been tested in living memory. Which scenario materializes depends on the pace of Bank of Japan normalization, the global financial environment in which that normalization occurs, the willingness of the two governments to manage the adjustment through the bilateral diplomatic channels that have served the relationship through previous tensions, and the specific random events, a geopolitical shock, a domestic economic development in either country, a global financial crisis triggered elsewhere, that the most sophisticated models cannot predict. What is certain is this: the specific financial architecture that has allowed the United States to run persistent large deficits financed by reliable Japanese demand is changing. The change is structural, not cyclical. The Japanese bond buying that has been the quiet, polite backstop of American fiscal profligacy for 3 decades is becoming less reliable, more expensive, and more conditional. America's largest creditor is reconsidering the terms of the relationship, not maliciously, not dramatically, but genuinely, rationally, and with the specific financial logic of institutions that have fiduciary obligations to the Japanese households whose savings they manage. The American economy, which has been operating on the assumption that Japanese demand for its debt is a permanent feature of the financial landscape, is about to discover that permanent in finance means until the conditions that produced it change. And those conditions are changing right now. The polite potential economic catastrophe that opened this video is not so much Japan destroying the American economy as the American economy confronting the specific consequences of having outsourced a critical component of its financing to a single foreign creditor for 40 years, and now discovering that creditor has its own financial priorities that may not align indefinitely with American convenience. The most polite wake-up call in financial history is already ringing. The question is whether anyone is listening loudly enough to do something about it before the alarm becomes a crisis.